Hello YouTube fans, friends, subscribers, and fellow traders. Just a quick update. I've had a lot of phenomenal comments and questions and so forth, especially on this top video that has over 250,000 views. And what I want to do real fast is I want to show you some proof. I don't have my trades currently right now. I have a membership website, Options Trader Club, where I do all my live tradings. I run trading rooms, and we have several members from all over the world that I teach how to become better options traders and using defined risk strategies, spread trades, a lot of debit spreads as well. But for the most part, I want to give you a rundown of my results, because this is really what it's all about, is putting this to work and letting it give you that rising equity curve that we're all here for. So right now you can see that I track all my trades through a tracking spreadsheet, and this is all through Google. Very detailed, very informative, and you can see the last several trades. It's kind of long, and I'm gonna go through this one by one, but the first 10 or so I want to look at. You can see I do a lot of vertical spreads. I also do some calendar and some time spreads, a couple other one-off like selling naked puts and going long leaps. So for the last 10, 12 trades, been in a very nice little hot streak right here. So these are my authentic, genuine results. These are not paper trades. This is live dollars, and you can see that the last 12 trades, this one's about to expire worthless this week, which was a short vertical put spread for TQQQ, which is on the leveraged ETF for the NASDAQ. But I'm doing a lot of ETFs because it simplifies the process. You can see a few one-off stocks like Amazon, Apple, Tesla. I do a lot with Wynn Resorts. Olds has been a great one this year, and also we have Facebook too. Earnings is today after the bell, so I'll be doing that later here when I have my live streaming for today. But this is what I'm doing. This is the streak that I've been on. This is not typical, but this does happen, and it could continue to happen because I'm in a great synchronicity with the market right now, and I'm making smart trades. My average hold time is right around 2 weeks, right around a 70% win ratio. And my average return on investment per trade, if you average it out, is right around 32% gain. And you can see some of these are upwards of 50%. But the most important thing is sticking to a plan, having capital preservation at the forefront of your mind, and being able to understand how this can work for you. So one of the trades that I really enjoyed putting on last week actually was on the VXX. And if you're not on my email list, go over to optiontradingcoach.com. That's my main website. Or you can go to optionstraderclub.com. This is the membership site, so it looks a little different on the front end, but opt in so I can at least give you some free education, some different trade ideas and actual trade picks that you can learn from. But this VXX trade is a great example of taking a profit off too early. I sold it in 4 days for a 45% gain. My average trade size is around 2, 3, sometimes 5,000, a couple around 10 or 20, but I try to keep it relatively streamlined for a majority of my members to follow. Not many people have mid 6 or 7 figure accounts, so this is a good framework that I've seen. And moving forward, I want to give you a couple takeaways. The election is days away, and it's been a very wild one at that. So what's going to happen? Is the market going to continue this 7-year uptrend that we've been in, or are we going to see a huge sell-off? All I know is that when you look at the S&P 500 index futures, if we do a 5-year daily, we even can do a 20-year monthly to really show you the significance of this bull market that we've been in. So from the low, or the beginning of 2009, or the lows of the '08 crash, from 2009 through where we are in 2016, which is the year's almost over, we've been up about 260%. So this very strong bull market is over 250% gain. I feel that we are more likely to pull back to a potential, this is a very, very pivotal support level at 1600, but very likely to pull back around 18 or 1900. So if we zoom in now to a little more accurate time frame, you can see like this 1850. These are the lows that we hit in 2016 in the beginning of the year. And also we hit this in August of 2015 when we had that Chinese kind of negative news. Actually, that's 2014. 2015 is also the same. So you can see this very clear level of support at 1850. We could definitely test 2000 in the very near future, and 1850 is definitely in the cards as well. So what I would say as a self-directed retail trader is, of course, identify the patterns, understand the trend, understand what you see and what you want to create. And then that's when you can validate that with some back testing, some strategy selection. If we look back real fast just to see what's working on the spreadsheet that I was just showing you, you can see that a lot of these winning trades and this win streak that I've been on, even if we go down here, there's still a lot of pockets of strength. I've had some trouble with a couple earnings plays that don't go your way, but I've been doing very well with these vertical call spreads and selling vertical spreads as well. So you can buy a vertical and you also sell one. But I like that mechanical makeup. It's simple, it works, people can follow along easily. And with this scenario on the S&P 500, if we take a subsequent product that trades on the S&P 500, like the SPY, which is the most prevalent one, you can see where we're at. We're right around 209, 210. If we trade down to 205 by the end of the year, what can you do with that? So if we look at the SPY, and this is just one legitimate trading idea, but if you take the expiration that we just talked about, you can even go out to January of 2017. I don't think you need to go that far. This December expiration is 44 days away from where we are right now when I'm shooting this video for you. But if you take the 210 strike, which we don't need to look at all these, simplify a little bit here. So there's a lot of information. There's a tremendous amount of liquidity of capital inside the option chains for the SPY ETF. We're trading right at 210, which is nice for choosing strike prices. But if we take the 210, we'll take that strike price because that's where we're at right now, and we're going to buy a vertical. So the whole purpose of buying a vertical is to help reduce the cost basis of your long option. So we're buying a long option right here. +1 means you're buying. +1 on the 210 means we're buying a 210 strike put option. And when you simultaneously sell like the 205, you create this long vertical debit spread, or this long, it's also known as a bear put spread in the educational world, but this is the technical word. If I was going to do this, you can see it's a vertical spread, and long means I'm buying. You can see it's a debit. If it was a credit, then it would be red and it would say credit here, but you can also see that I'm paying $1.75. So to do one contract or one lot, because this is a married trade, you can't do a vertical spread. You could leg into it, that's a little more advanced, but we're putting this on as a package trade, paying $1.75. I'm going to lock that price at $1.75, and then you can see, what can you make on this? Well, if I hit this confirm and send button, it'll tell you very easily, but I want to explain this because when you have a $5 spread risk, then the most that you can make is the difference of that spread subtracted by your debit or your out-of-pocket expense to put the trade on. So if you can make a total of $500 for one contract here and you're paying $175, that means you're risking $175 to make $325 if the SPY trades down to 205 by the December 2016 on December 16th expiration. One more thing that I'm doing is going to analyze this trade, and the reason why you want to do a vertical spread and the reason why I am not an advocate of buying short-term calls under 90 days or short-term puts like in this example is because they decay very fast. They have what's called a negative theta, which is negative time decay because options are decaying assets. But you can see right here, this is the same trade. This is my risk profile. We're at right now on this purple line, which is my break even, pretty much where we are. And this gives me the ability to neutralize my theta, and it has a pretty decent negative delta risk, which means I'm short the S&P 500 because I think it's going lower, or negative deltas as we call it. And minus 14 is my share. So I'm short 14 shares. If we trade down to 205 in the next couple of days, you see how I make 50% on my money. If I'm putting up 175, this will make $75. And you can scale it. If that doesn't excite you, then put 2 zeros behind it. And you can say I'm risking $17,000 or 17.5 to make $7,000 in potentially a week or a day. Depends how fast or how much the market falls. But the nice thing about this application here is you can change the date and you can really do some extrapolation. But say by December 1st, this is trading at 205. You see how that 7,200 just went to 11.5 right there? That shows you the mechanics of this strategy. And this is just a taste of what I can teach you if you become a member of the Options Trader Club, and really what we're doing on a daily, weekly, and monthly basis. And that's all about giving you clarity, giving you confidence, and giving you smart trading strategies that can work whether we continue this 6-7 year bull market or if we start to get into a bear market and see a major sell-off, which you have to understand that markets fall a lot faster than they rise, and you can make a tremendous amount of money if you know what you're doing in a bear market when things turn. So that's all for now. If you need any other help, feel free to visit me on optiontradingcoach.com or Options Trader Club, and I look forward to hearing from you and seeing you inside the community. Take care. Happy trading. Thanks so much.